Welcome back to Financial Fundamentals, where we break down money concepts in a way that actually makes sense. Today, sit back, listen up, and learn about net worth, what it is, why it matters, and exactly how to calculate yours. By the end of this video, you will have a clear, simple formula you can use today to get a real picture of where you stand financially. Let's get into it. Here's a question a lot of people never stop to ask. Am I actually getting ahead? You might be earning a decent income. You might be making your payments on time. Things might feel fine on the surface. But feeling fine is not the same as actually building financial stability. And that is exactly where net worth comes in. Net worth is the single clearest number for understanding your true financial position at any given moment. Not your income, not your credit score, your net worth. And here's the simple truth that makes this so powerful. Net worth is just what you own minus what you owe. That is it. Everything you own minus everything you owe. One number, one honest snapshot of where you are right now. So why does this matter to everyday people? Because most of us use the wrong things to measure our financial progress. We look at our paycheck and feel good when it goes up. We look at our lifestyle, the car we drive, the apartment we live in, and assume that means we're doing well. But here's the thing, income is what flows in. Net worth is what you keep. Those are very different things. Think about someone earning $300,000 a year. Sounds like they are doing great, right? Now imagine that same person has $300,000 in debt, no savings, and nothing invested. Their net worth could be close to zero or even negative. Meanwhile, a teacher who earned a modest salary but saved steadily and paid down debt over 20 years might have a net worth of $400,000 or more. The teacher is genuinely wealthier by this measure, even though the income comparison would suggest the opposite. Tracking your net worth over time helps you see whether your financial decisions, saving money, paying down debt, investing, are actually moving you forward. It turns all of those abstract good habits into a number you can watch grow. And that feedback is genuinely motivating. Now let's talk about how to actually calculate it. The formula is simple. Net worth equals total assets minus total liabilities. Let's define both of those terms clearly because they are the building blocks of everything here. Assets. That word just means things you own that have value. We are talking about the money in your checking and savings accounts, any investments you hold, retirement accounts like a 401k or an IRA, the current market value of your home if you own one, the current value of a car or vehicle you own, and any business equity, meaning the value of a business you own after subtracting what that business owes. All of that goes into the assets column. Liabilities. That word just means things you owe. Debts. Your mortgage balance, student loan balances, credit card balances, auto loan balances, personal loans, any money you are obligated to repay goes into the liabilities column. Add up everything you own. Add up everything you owe. Subtract the second number from the first. That result is your net worth. Now, there is one important rule when it comes to valuing your assets, and a lot of people get this wrong. Your assets should be listed at what they would realistically sell for today, what is called fair market value. Not what you paid for them, not what you hope they are worth, what you could actually get for them right now. Here's a quick example to make that concrete. Say you bought a car 3 years ago for $30,000. That felt like a big number, and you paid $30,000 for it, but cars lose value over time. That is called depreciation. And today, if you sold that car, you might only get $18,000 for it. So when you are calculating your net worth, you write down $18,000, not $30,000. Using the purchase price would make your net worth look bigger than it actually is. And that defeats the whole purpose of the exercise. The same logic applies to a home, to collectibles, to anything whose value changes over time. Use today's realistic market value. When in doubt, a quick search of comparable sales in your area for real estate or checking a vehicle valuation tool for a car can give you a reasonable estimate. Okay, let's pause and recap what we know so far, because we have covered some important ground. Net worth is what you own minus what you owe. Assets are things you own. Liabilities are debts you owe. And assets should be valued at what they would sell for today, not what you paid for them. Here's a question to sit with for a moment. If you had to write down everything you own and everything you owe right now, do you have a rough sense of which side would be bigger? Most people have never actually done this exercise, and that is completely okay. By the end of this video, you will know exactly how to do it. let's talk about something that surprises a lot of people. Net worth can be negative, and that is not a disaster. It is actually very common, especially for younger adults. If you have student loans and you are just starting out, your liabilities might be bigger than your assets right now. If you just bought a home and your mortgage is large relative to the home's current value, the same thing can happen. A negative net worth is not a failure. It is a starting point. The goal is to track it over time and watch it move in the right direction. Here is another thing worth understanding about net worth. It is a snapshot, not a scoreboard. It is not something you need to check every single day. Asset values go up and down, the stock market moves, home values shift, and if you obsessed over your net worth daily, you would drive yourself a little crazy. Most people find it useful to calculate their net worth once a month or once a quarter. What you are looking for is the long-term trend. Is it moving in the right direction over months and years? That is the question that matters. There is also something called liquidity that is worth mentioning here. Liquidity just means how quickly you can access money when you need it. Two people can have the exact same net worth and be in very different situations financially. Imagine two people, each with a net worth of $100,000. One person has that $100,000 sitting in a savings account. The other person has that same $100,000 tied up in home equity, meaning it is the difference between what their house is worth and what they still owe on the mortgage. Both have the same net worth on paper, but the first person can access their money quickly in an emergency. The second person would need to sell their house or take out a loan to get to that money. Same number, very different financial flexibility. So as you think about your own net worth, it is worth noticing not just the total, but how much of it is liquid and accessible. Now let's walk through a worked example together. This is just an illustration, made up numbers to show you how the math works in practice. Imagine someone sitting down to calculate their net worth for the first time. On the asset side, they have $5,000 in a checking account, $15,000 in a retirement account, a car that is worth $12,000 at today's prices, and a condo with a current market value of $250,000. Add all of that up. 5,000 plus 15,000 plus 12,000 plus 250,000 equals $282,000 in total assets. On the liabilities side, they have $8,000 in credit card debt, $22,000 in student loans, and a mortgage balance of $210,000. Add that up. 8,000 plus 22,000 plus 210,000 equals $240,000 in total liabilities. Net worth equals assets minus liabilities. 282,000 minus 240,000 equals $42,000. $42,000. That is this person's net worth. Not a fortune, but a real positive number and a clear starting point to build from. Now, a quick note on the flip side of this. The formula for net worth is simple and honest, but it only works if the numbers going into it are accurate. There is a fascinating real-world example of what happens when they are not. Back in 2019, Forbes, one of the most recognized financial publications in the world, estimated Kylie Jenner's net worth at $1 billion and called her the youngest self-made billionaire. That was a huge headline. But in May 2020, Forbes retracted that figure. They determined that documents that had been used to support the valuation, including tax records, appeared to have been forged or falsified to inflate the number. The actual figure was significantly lower. The lesson here is not about any one person. The lesson is that a net worth figure is only as trustworthy as the information behind it. Whether it is a celebrity being covered by a major magazine or you sitting down with a piece of paper, the formula is simple, but the inputs have to be honest. Realistic asset values, real debt balances, no rounding in your favor just to make the number feel better. Honest inputs give you a useful number. Inflated inputs give you a feel-good fiction. Here's something to think about. What is one financial habit, saving a little more, paying down a debt faster, or cutting an expense, that you think might actually move your net worth in the right direction? Drop that in the comments. Seriously, it is a useful thing to put into words, and we would love to hear where you are at. Let's bring this all together. The one big takeaway from today is this. Net worth is the clearest single measure of your financial health, and calculating it is simple. What you own minus what you owe. Track it over time, monthly or quarterly, using realistic, honest numbers. watch the trend. And remember, whether your number today is positive, zero, or negative, what matters is the direction it moves from here. That is what Financial Fundamentals is all about, giving you the tools to actually understand your money, one concept at a time. If this video helped you, please give it a like. It genuinely helps more people find this content. And if you know someone who would benefit from understanding what net worth is and how to calculate it, share this video with them. Knowledge like this is more useful when it spreads. If you have questions, or if there is a money topic you want us to cover in a future video, leave it in the comments. We go through every comment, and your questions help shape what we cover next. And if you are not subscribed yet, now is a great time. We break down one money fundamental at a time, and there is a lot more coming. This video is for educational purposes only and is not financial advice. Markets and investments carry risk, including the possible loss of principal. Always do your own research and consult a licensed financial professional before making investment, tax, or money decisions.